Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. First and foremost, a big thank you once again to Fox Business Network, Maria Bartiromo, Mornings with Maria, for including us again last week to recap this Fed meeting. A very, very interesting meeting. Obviously, no change in formal rates, but a very dovish Powell, again, Chair Powell, in our view, with sort of this notion that the economy doesn't necessarily need to go into a recession for inflation to continue to come down, and then perhaps the Fed to begin lowering rates a little bit later this year. Talking about the employment market, talking about downside risks potentially to the employment market, which we've written to clients now for months, is certainly a game changer, but also saying that he doesn't think the employment market needs to deteriorate materially for inflation to continue to come down. So very interesting dynamics. But let's kind of talk through this a little bit. If you look at the Fed chair over the last 5 months, let's go back to 2023, and we get the PCE deflator later in the week, although the bond market will be closed on Friday. You look at the inflation readings from last year. They started out kind of sticky, sort of the same way they're starting out this year, a little bit high. Those prints are going to start to roll off, so year over year will begin to look better. And then we started to get into the zone for the Fed, that 0 to 0.2, 0.3 month over month readings in succession leading up to the Powell pivot early November, in our view. Late October, bad month for the bond market, 10-year yields above 5%. And then November, December, those meetings, taking risk assets higher, taking treasury rates lower, taking financial conditions looser. He had the wind behind his back. And then saying in the meeting last week, too, they didn't overreact to the better prints. They're not going to overreact here, but they're not going to ignore the prints that we're seeing now. That's the zone the Fed needs to be into on a month-over-month basis. They need to be, and if you look back historically, to achieve that 2.5% inflation, they need to be in that 0 to 0.3 range. So clearly, the first couple of months of this year, not cooperating. Again, another PCE number this Friday, which will be important. But from a financial conditions perspective, the Fed chair has certainly been dovish. He's had multiple chances in the course of 2024 to push back on looser financial conditions and didn't. He didn't at the January meeting, certainly not in March. When asked about overall financial conditions, he said they still remain tighter, and they do. The reality is financial conditions do remain tighter than when the Fed started to begin the tightening cycle in 2022, but certainly within this pocket of time, loosening. And if you look at it very clearly, if you look at the Bloomberg Financial Conditions Index, it is interesting. We're at levels now that we haven't been at really since 2021. In 2021, we had zero interest rate policy, and we also had the Fed buying $180 billion in securities per month. Now we have the Fed rolling off half of that, not specifically half of that because the mortgages aren't fully cooperating. And at the same time, we have a Fed funds rate that's 525 basis points higher. Financial conditions now almost as loose as they were back in 2021. So what is that telling us? Well, in the end, it's probably telling us that the neutral rate here is higher. The economy is certainly behaving that the neutral rate is higher. I mean, the Fed nudged it up a little bit last week in the summary of economic projections. We don't know exactly where it is, but for all intents and purposes, with all the work that the Fed has done, market-based financial conditions here are extremely loose. Markets are doing extremely well. So it does create a bit of a dilemma for the Fed, in our view, when you look at what markets are doing relative to the fact that the markets are saying the Fed's going to come down and ease here. These are not really easing numbers on the surface. So what does that mean here going forward? We went from over 6 rate cuts down to 3. The markets feel comfortable here that the Fed will come down 3 times. And like we've been saying, I mean, the market's done relatively well. But the data here in this window of time is going to be important. This PCE will be important. We move into the employment number next week. We're going to be watching the household survey to see if that unemployment rate ticks up again. That would certainly be in the dovish camp with regard to what Chair Powell said last week. And then we're also going to be looking at wages. In the end, we do believe the Fed chair here is looking past some of the pandemic dynamics, some of the dynamics that we've seen over the last couple of years, looking at productivity gains coming back, look at longer term trends in wages That's kind of what we're hearing. In conjunction with that, we're also hearing the ECB, we're also hearing the Bank of England. We had the Swiss National Bank lowering rates last week. China's already been easing here throughout the course of this time frame, and Bank of Japan is a complete anomaly here on the way in and on the way out. So the tone globally has been dovish, including Chair Powell. They are all pointing to a certain extent, and markets are embracing this June time period for the Fed to potentially begin lowering rates. The Bank of England, the ECB also as well, with a close eye here on the data. On the ground this week, what matters is Fed Governor Waller, a very influential Fed governor, closely watched, a market mover at times. He has said repeatedly recently with this uptick in inflation that he needs to see more months of good data, more months of data now coming back down to where we were throughout the course of 2023, that disinflation data. Why it matters is to the extent that he repeats that narrative, well, it makes the May timeframe for a potential rate cut very difficult, and potentially how the data plays out and what the narrative is coming from the Fed speak, it also then could put into question that June timeframe as well. So it's important. So Fed Governor Waller on Wednesday. We also get Chair Powell with a question and answer session on Friday. We'll get the PCE on Friday. That's going to be followed up by the employment number a week from this Friday. We've got 2 weeks of very, very important solid data here. To all of our friends and followers that celebrate the Easter holiday, want to wish everyone a very happy, healthy, and more importantly, peaceful Easter weekend. I'm Greg Faranello. I'm head of U.S. rates for Amerivet Securities.